Fixed income investments have long been seen as the backbone of a balanced portfolio. But here's a thought. Are they actually helping you grow wealth or just giving you the illusion of financial safety? For decades, bank fixed deposits (FDs) have been the go-to. They are simple, familiar, and come with an air of security. But with FD rates often lagging behind inflation, isn't it time to ask, are they still enough? And if you're someone who's seeking more than just capital preservation but not ready for the unpredictability of equity markets, what are your options? That's where platforms like Grip Invest enter the picture, offering access to corporate bonds, securitized debt instruments, SDIs, and more just a few clicks away. So it sounds promising, like better returns than FDs, curated options, professional due diligence, but here's the catch. How much of this promise actually holds up? Can a tech platform truly mitigate credit risk? What happens if things don't go as planned? And more importantly, does this align with your long-term financial strategy, or is it just a shiny new wrapper on an old risk? Let's break it all down in this video. So first, let's understand the bond market. Hi there, welcome back to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So let us first understand the bond market. Have you ever been lent money to your friend and expected it back with interest? That's essentially what a bond is, but at a formal level. Bonds allow governments and companies to borrow money from the public, promising to repay with interest. But what makes this market tick? Why is the bond market called the backbone of the economy? And if it's so important, why don't more retail investors participate? The answer is simple. Lack of access, awareness, and ease of investing have historically kept retail investors away. Platforms like Grip Invest are now trying to bridge this gap. Second, what is a bond? So at its core, a bond is a loan made by an investor to a borrower. The borrower agrees to pay back the principal along with periodic interest. Simple, right? But what if the borrower defaults? How do bond prices change with interest rate? Can you sell a bond before maturity? And if so, how easy it is? These questions show why understanding a bond's terms, ratings, and liquidity is essential before investing. Next up, we have government bonds. Think of these as the gold standard of debt investments in India, issued by the government of India. They offer unmatched safety, but can they beat inflation? How easily can you liquidate them? Is the process user-friendly for retail investors? Are there any hidden costs or liquidity traps? While G-Secs provide safety, they may fall short on liquidity and returns, making them ideal for conservative investors. So the minimum investment is 1,000 rupees in multiples, and you can invest through RBI Retail Direct Portal. And next up, we have private or corporate bonds. So why were corporate bonds out of reach for so long? High entry barriers. But now with SEBI lowering the minimum to 10,000 rupees, retail investors have new opportunities. Still, key questions remain. How do you judge which corporate bond is trustworthy? Should you only go for AAA rated ones? Do higher yields always mean higher risk? And how do you check a company's fundamentals or debt servicing history? So corporate bonds offer attractive yields but demand careful research and risk assessment. Would you lend your money to someone without knowing their repayment capacity? Probably not. That's where credit ratings come in. But how reliable are these ratings? Have there been defaults even among high-rated instruments? Should a downgrade worry you? Can a single rating capture a company's true financial health? Credit ratings are a useful starting point, but they are not the whole picture. Look at cash flows, business fundamentals, and industry trends. And here on the screen, we have presented a quick list of the major players, which you can pause for your reference. So do they all rate bonds the same way? How often do they update ratings? Could conflicts of interest arise since insurers pay for ratings? So these are some questions you need to ask yourself, because check ratings across agencies and stay updated to take an informed decision, especially in a volatile market. And we do also have presented a simplified rating scale for your reference on the screen. So now another thing to importantly remember is not all debt is created equal. Bonds vary in safety depending on what backs them. So senior secured bonds are backed by collateral, so it is the safest. Senior unsecured bonds have no collateral, so it has higher risk. Subordinate subordinated bonds repay only after the senior bonds. So it has higher risk, and perpetual bonds have no maturity, meaning it has the highest risk. So if the issuer goes bankrupt, who gets paid first? Can you recover anything? Does collateral actually offer real protection? For conservative investors, prioritizing secured over unsecured debt is often wise. Now let's take a look at the Grip Invest platform features. Grip Invest is a SEBI registered online bond platform provider. So connecting investors to options like corporate bonds, SDIs and corporate FDs. They promise better than FD returns, regulated credit rated products. But key questions remain. Does SEBI registration ensure total safety or just minimum compliance? How thoroughly does the platform highlight risk? Can you rely solely on platform filters for decisions? While SEBI oversight limits fraud, it doesn't eliminate credit risk. Investors must do their own due diligence before committing to capital. So now what does the Grip Invest actually offer? So Grip Invest offers a curated range of fixed income instruments designed for predictable returns with varying risk and liquidity. So here's what's on the menu. First, we have listed corporate bonds, which is publicly listed bonds from reputed companies offering fixed returns and potential secondary market exit through liquidity may vary. Next, we have securitized debt instruments. So they are structured products offering fixed returns backed by varying levels of security and credit rating. And next, baskets. So these are pre-packaged portfolios combining bonds and SDIs for instant diversification. And lastly, we have corporate fixed deposits, which are company issued FDs offering slightly higher returns than banks but with varying credit quality. So each option serves different risk appetite and timelines, but don't let convenience cloud your judgment. And here again we have SDI. So let's take a closer look. So let's dig deeper into this Grip's 3 SDI options which it offers. First is Lease X. So lease mission critical assets to established companies backed by physical assets rated A to BBB. Next we have Invoice X. So this fund invoices from large corporates, offers monthly payments backed by cash collateral rated A2 plus A1 plus. And we have another Loan X. So loans via RBI licensed NBFCs with extra protections like over collateralization and cash reserves rated AA to A. So these SDIs come with built-in security, but their credit ratings aren't AAA, meaning there's still risk involved. If an issuer defaults, recovery can be tricky. Monthly, quarterly, even semi-annual payouts sound appealing, right? But before you celebrate, are you missing out on compounding? Could reinvesting manually or opting for a mutual fund growth plan yield better long-term returns? And what if the issuer misses a payout altogether? For income seekers, it's great. But if you're building wealth long-term, focus on total returns, not just cash flow. Next, let's take a look at the minimum investment requirements. So for listed bonds, it is 1,000 rupees, and SDIs like Lease X, Invoice X, Loan X, it's 1 lakh, and for baskets and FDs, it is 5,000 rupees. Is it accessible? Yes, but ask yourself, can you comfortably lock in these amounts? Do they align with your emergency fund and financial goal? Remember, low entry points don't automatically make an investment right for you. Now let's take a look at the platform perks. So it has seamless onboarding on mobile and web, risk profiling tools, and advanced filters for product type, risk, tenure. It sounds convenient, right? But here's the catch. Can a filter really assess credit risk? Could a sleek dashboard be masking complex underlying risk? Use the platform as a tool, not a substitute for sound judgment. Now, Grip claims returns up to 200% of FD rates with less risk than stock. But let's unpack that. Traditional FDs give 6.5 to 7.5% returns backed by DIC GC insurance for deposits up to 5 lakhs. Grip's SDIs and bonds may offer double that but with higher credit risk, poor liquidity, and real chances of default. Remember, while stock prices can be volatile, they don't default. Lower rated bonds and SDIs can. So, who should consider GRIP? So, GRIP might suit debt investors comfortable with more risk, or aggressive savers wanting higher returns, or investors allocating a small slice of their portfolio to alternative assets. But ask yourself, can I handle a potential default? Am I okay with limited liquidity? And does this fit into my long-term financial plan? Never invest here until you have built an emergency fund, covered your financial basics, and established a balanced asset allocation. And you also need to be completely thorough with the tax implications. You should know this before you invest. That's why we have presented the tax implications on the tabular column on the screen, so which you can pause and see for your reference. So you always need to factor in the taxes. That high return might shrink significantly once the taxes are deducted. That's why you need to always factor in the taxes. Now we have all seen it. Equity markets can swing wildly. A crash might wipe out 50 to 60% of your portfolio. But here's the key difference. Equity funds don't default. Your capital isn't lost unless you panic and exit at the wrong time. Historically, markets recover. Patient investors often come out stronger. Now let's talk bonds. What happens if the bond issuer fails to pay interest or principal? That's a default, and it can mean permanent loss, and we have seen this happen. So DHFL in 2019 over 1500 crore defaulted. ILNFS 2018 91,000 crore default that shook India's financial system. Yes Bank 81 bonds, which is retail investors, lost everything. So are bonds less risky just because they are not stock? Not exactly. Even senior secured bonds carry credit risk. If the collateral drops in value or recovery takes years or doesn't happen at all, you're stuck. Now, equity mutual funds bring diversification, liquidity, professional management, and surprisingly strong risk-adjusted returns over time. So instead of asking which one is safer, ask, can I handle equity's volatility? Am I prepared for illiquidity or a default in bonds? Does my portfolio balance growth with safety? Smart investing isn't about picking sides. It's about knowing your risk and owning it. Now let's rewind to April 2020. Franklin Templeton, a trusted name, suddenly shut down 6 debt funds. Over 25,000 crores of investor money were frozen. The funds hadn't failed. They were top performance, but the pandemic caused panic redemptions. Franklin's low-rated, illiquid bonds couldn't be sold. Investors were locked out of their money. Most eventually got their capital back, but it taught us strong past returns don't protect against hidden risk. Even SEBI-regulated funds can freeze under stress. Now imagine if Franklin funds with daily NAVs, SEBI oversight, and professional management could freeze. What about unlisted bonds from lesser-known issuers? No regulatory NAV, no guaranteed liquidity, and no fallback protection. So the credit risk is tricky. It's like an earthquake. Everything seems fine until one default triggers a domino effect. Products like SDIs on GRIP Invest may look like safer alternatives to FDs, but higher returns come with higher risk. Recovery after default is slow and uncertain. Bonds are illiquid. Exiting early may mean losses. So if you prefer SEBI regulated credit risk mutual funds, they are helpful for diversification, transparency with daily NAVs, and liquidity and professional management. Or if you want zero default risk, you can consider sovereign bonds via RBI Retail Direct. So what are the final key takeaways from this video? Past returns is not equal to future safety. SEBI oversight doesn't mean capital safety. No investment is risk-free, especially not lesser-known bonds. A slick platform can't hide fundamental credit risk. So GRIP Invest offers innovative fixed income products with attractive returns. But don't let convenience fool you into ignoring risk. Before you invest, ask, what if the issuer defaults? And check, Can I handle the loss? And then consider, is there an exit route? Even reputed mutual funds can face stress. Unregulated or lesser known bonds carry more risk, not less. So, working with a certified financial planner can help you. Create a debt strategy aligned with your goals, balance risk, return, and liquidity, and avoid locking your money where you can't access it when needed. So, Grip Invest can be a useful tool for seasoned, risk aware investors with non core capital. For everyone else, stick to better understood, liquid, and regulated options. So, the key message is a small boost in returns isn't worth sacrificing your peace of mind. So, like and share if you found this video helpful, and comment below if you would like us to cover more on alternative investments. And don't forget to click the link in the description for a free consultation with a CFP to create a portfolio that matches your goals and risk profile. So, until next time, thanks for watching. Stay informed, stay smart, and as always, invest wisely.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.